Welcome to Markets Radar with Jeremy Quintanilla, where I break down the stories moving in the markets, stocks, bonds, crypto, and everything in between. I'll give you my take on what it all means. Let's dive in. Welcome to today's episode. Before we get started, make sure to follow me everywhere at Age of Jeremy, and also make sure to join my Instagram, Dope Insights and Updates. Make sure to watch on my other shows as well. I have a live show I do on Mercury by Age of Radio, where I go over podcasting and pop culture news. And then I'm also on the new Wealth Transfer podcast on the 3T Warrior Academy. So make sure that you check all of those out. In this episode, we navigate a wave of global market volatility from a broad tech sell off pulling down the major US indexes to a historic leverage fueled 16% swing in South Korea's Kospi index. So, taking a look at a foreign market today. Amid the turbulence, the AR arms race is only accelerating. We break down OpenAI's confidential filing to join a staggering 3.6 trillion artificial intelligence IPO pipeline and discuss the red flags surrounding a massive $2.3 billion insider stock liquidation by founders of AI data center darling CoreWeave. Finally, we're going to explore the shifting power dynamics in big tech and Apple's latest AI upgrade leaves it increasingly dependent on Google's cloud and chip infrastructure. We'll talk about those in some capacity during this, maybe not exactly in that order. And so stay tuned, and we're going to unpack what these massive shifts mean for your portfolio. To kick us off into the day, this is recorded on June 9th, 2026. This news may have changed by the time that you hear it, but the Nasdaq has dropped roughly 2%. The S&P 500 is down just over 1% at the time of this recording, and the Dow has shed over 160 points in today's trading on June 9th. Unsurprisingly, market volatility is spiking alongside this drop, with the VIX up more than 12%. On the macroeconomic front, Bank of America is warning of red flags in the US stock market. No shit. This comes as the bond market looks at a Fed chair wars to take a few stances, especially with inflation threatening a top 4% this week. And again, I do not believe in Citigroup. Citigroup could be right. I could be wrong. Citigroup has said that they're going to lower the interest rates 3 times this year. I think it's going to be September, October, and December, if I'm not mistaken. I don't remember the other 3 times, but I think that they're going to keep it the same on the first two, and they're going to raise it in December to get this inflation under control. But Warsh has a fun stance to take. Based off of the fact that Donald Trump likes things Donald Trump's way, and Donald Trump's want those interest rates down to cozy up to his capitalist friends. But when the economy is where it's at with a 4% inflation, I think that we need to do something to curb that. And that's the reason why we have the Fed, so that they can make that decision apart from the government and politics, even though politics seem to get dragged into it. Meanwhile, we're seeing some much needed relief in the energy markets following our previous coverage of the US Iran standoff in the Strait of Hormuz. Oil prices have reversed courses and are falling today. And I did that coverage vis-a-vis an Instagram post. I didn't actually make that into the episode. My apologies. I'll do better in the future. Brent crude is down over 3.6% to around $90.82 a barrel, and US crude has dropped 4.5% to 87.19. This sharp drop comes directly on the heels of statements from President Trump indicating that an Iran deal, my apologies, could be reached in just 2 or 3 days. Finally, in IPO news, the trillion-dollar mega IPO wave continues to build. While we've been closely tracking SpaceX's massive upcoming debut under the ticker SPCX or SpaceX, surprisingly, OpenAI has now confidently filed for its own IPO, and that is where we are going to get started today. There's an unprecedented 3.6 trillion artificial intelligence IPO surge that is reshaping the entire public markets. AI is taking over everything, in my opinion. It's taking over all the news because I'm going to be talking about it a lot today. Just this week, ChatGPT creator OpenAI confidentially filed for an IPO with the SEC, working with Goldman Sachs, Sachs, and Morgan Stanley on a potential listing as soon as this fall. Based on its most recent funding round, OpenAI is already valued at a whopping $852 billion, which is ridiculous because I don't even think that they make that much money, but they are the only giants entering this arena. Rival AI developer Anthropic also filed confidentially for its own IPO last week, boasting a massive $960 billion valuation. And uh, and towering above all of this is Elon Musk's SpaceX, which, if you listen to Saturday's episode of Market Radar, I went over that, which is preparing for an IPO behemoth of $1.8 trillion valuation, also probably minting the first trillionaire CEO in history. Maybe even the first trillionaire in history. I'm sure that there's some oligarchs and aristocrats out there that probably have $1 trillion. Maybe Putin. I don't know. He seems to be maybe might have $1 trillion somehow. As we covered in the previous episode, the mega IPOs are setting up a historic clash with Wall Street's index gatekeepers. As I mentioned on last week's episode, despite debut valuations that eclipse nearly every company currently in the S&P 500, these tech behemoths are effectively locked out of the premier index due to strict GAAP profitability. That index being the S&P 500. Why? Because they're intentionally operating at massive losses to fund the trillion-dollar AI hardware race. SpaceX would be a very profitable company if it wasn't bundled up with XAI. And the problem with Anthropic, who is doing a lot better, I don't remember the exact number off the top of my head, but it is surpassed, and actually with this valuation, is surpassing the valuation of OpenAI. Anthropic is actually growing its revenue as opposed to OpenAI, who doesn't know what the fuck is going on in anything. And one week they're making, I don't know, speakers. The next week they're focusing on their codecs. The following week they're starting a podcast. Who knows what the hell Sam Altman's doing in there? That's just my opinion. I'm a big fan of Claude. In fact, a lot of this is a lot of my images that I've been doing for images for this show and for Age of Jeremy are made with a mixture of Notebook LLM or Notebook LM, and then also with Claude to clean up some of the coloring and verify a lot of the data on it, right? Which is, in my opinion, a good use of AI. But then for me to continue to be involved with it, so I know whether or not the information is accurate, and that's where one of the big problems happens. The capital expenditures required to win the AI arms race are astronomical. SpaceX poured 12.7 billion into AI capital expenditures in 2025 alone. Meanwhile, OpenAI has told its investors that it has plans to spend roughly 600 billion on AI infrastructure by the year 2030. So what exactly is all of the capital going? For SpaceX, it's about vertical integration and controlling the physical constraints of AI growth through their TerraFab initiative, which we talked about on Saturday, which is a collaboration with Tesla and Intel. Oddly enough, Intel being owned 10% by the United States government. SpaceX aims to build the world's largest chip manufacturing facility with the ultimate goal of producing 1 terawatt of compute hardware each year. SpaceX ambitions don't stop on Earth, recognizing that terrestrial power grids cannot sustain the exponential energy demands of future AI models. SpaceX plans to deploy massive orbit AI compute data centers as early as 2028. By using their fully reusable Starship rockets to launch these specialized satellites, they intend to harness the near constant, uninterrupted solar energy available in space to power the next generation of artificial intelligence. So, what we're really witnessing here is a fundamental shift in how the world's most critical infrastructure is built and funded. While the S&P 500 might be keeping these tech titans out for now, rival indices are changing their rules to fast track their entry, ensuring that billions in passive buying will flow into the space AI economy. And so one of the biggest things that we're going to see is that the space economy and the AI economy are going to be start to be construed together, which is only one of the problems with this entire economy. Is the fact that what we're going to do is we're going to start building AI more integrated into all of our infrastructure, which again, I think as long as there's guardrails in place and the government does a really good job on looking at these things and monitoring them, I think that there should be more policy in place where artificial intelligence companies, and to this point with space companies, they need to go through the government, unfortunately, to get approved for their language models. The other problem that I think that's arising as it relates to artificial intelligence in the United States is that the government's not on the same pathway of how they want to handle the situation. One of the reasons why China does so well, why China is now on the forefront of technology and starting to beat us in many, many ways, is because they don't have political parties. They have one political party. So what they get to do is they get to argue over policy and how to make things better for the Chinese people. Yes, I'm sure that there's still some concepts of dictatorship. I'm not Chinese. I don't live there. I've never been there. So I can't make an assessment on that. But the assessment that I can make based off of the stuff that's coming out of China is going to kick our ass because they can move faster and they're all moving towards the same specific goal, which we in America, we are not going towards the same different goal because we are left fighting with different ideologies. I do not mean that we have to start coming together and being a dictatorship. What I'm suggesting is that we have to sit down and have really good conversations on what it means to properly push these things forward for humanity and for Americans, and not trying to do what is best for the people that are donating to us to get into political office, the big corporations that need certain things to happen. We don't need any more of this crony capitalism to continue to happen. And for Ken Griffiths to go out there and say there isn't crony capitalism in the United States, all you have to do is look at SpaceX and AI and the techocracy and the tech bros, because this is turning into a giant techocracy and the government needs to monitor that and manage it. In relation to OpenAI and Anthropic going public, I think that's great. Do I think these valuations are absurd? Absolutely. I do not think these valuations need to be this high, but we have these leaders in these three companies that people believe in, and so they're able to go to market and spin a story of the future of humanity, a story of the future of mankind becoming a multiplanetary species, to have robots, assistants, and have agents do things for us, becoming a more efficient society utilizing their tools, when that's kind of irrelevant in the concept of whether or not the company can make money. It can manage its expenses. It can create dividends for its shareholders. It can create growth and value for their shareholders. People aren't thinking about those things. But do I think that these companies can be very successful in the long term? I would put Anthropic over Claude because I think Sam Altman, I'm not a big Sam Altman, I guess, fanboy. I'm a Musk fanboy in regards to his work ethic. And Anthropic's CEO, I can never remember his name, but he seems like a very good guy, kind of snobby when it comes to his uh kind of snobby on how he talks about his principles. I think him having his principles and the things that he believes in is very good, and I think that he could be a very good CEO, and I think Anthropic's going to outdo both of their AIs, and I think that Google is going to outdo Anthropic. The other problem that's arising with this, and we're going to talk a little bit later about a CoreWeave situation, which is an AI infrastructure data center publicly traded company, is that a lot of these deals are revenue going over to one company that's going back over to another company. They're kind of all playing, in my opinion, with the same money. They need to figure out what their revenue model is specifically going to be, and then just go hardcore into that. That's the reason why I think Anthropic's going to be better. They're really focusing on their a subscription based model. I don't know what OpenAI is doing because, like I said, one day they're wanting to work with Johnny Ivy on a speaker. The next day, they're focusing on how amazing Codex is as opposed to Cursor or some other AI vibing coding software. Then another day, they're focusing on they're focusing on, Sam Altman putting out a podcast that happened before those other two. And then they're buying a podcast company. I forgot the company. It's a news company. Like, I think some of the things that they're trying to do is like they don't have a specific focus, a focal point. And one of the things that you need to do when you're a new company, and I fall into this, you have to really figure out what that revenue model is going to be. What's the main thing that you need to focus on? Focus on the main thing, get that going and get that build, and then add in the other pieces based off of the skill sets and the things that you've learned along the way of doing that first thing. And I think that they don't do that. Again, I can't say that I'm in the same exact spot that they are, being that they are billionaires, but I can make an assessment of what I think can work for them. And I don't see at least OpenAI doing that. So if I had to guess, I would put Anthropic over OpenAI and what it's going to achieve. And eventually a lot of these will probably get consolidated and bought out. Moving on to another tech giant, because apparently that's the only news that exists, or at least the news that people want to hear. I don't know. I'm going to try to find some other news that I want to hear, that I think that you'll want to hear, but I think you might want to hear this too. Apple's becoming increasingly dependent on one of its biggest competitors, Alphabet's Google. Apple historically underinvested in these models. Its new AI tools were actually trained using Google's Gemini chatbot. While simple tasks will be handled on the iPhone itself, complex requests will be sent to Google's data centers, running on Google's cloud infrastructure and utilizing its powerful TPU and Nvidia chips. In many respects, Apple is effectively becoming a wrapper around Google AI's capability, which is why I'm very long term on Google winning a lot of this race. I think that Google DeepMind is a much better research facility and creator of AI and language models than any of the other ones that are out there. Building core AI models is now so technically challenging and eye-wateringly expensive that only a handful of companies can manage it. This gives the major cloud computing vendors that lease out data centers to train and run these systems like Google, Amazon, Microsoft, and now SpaceX unprecedented leverage over the rest of the tech industry. And this is one of the biggest failings I think that Tim Cook has had, is not getting into AI when he should have gotten into AI or predicting this or building it. But that being said, the one thing I will say, I heard this on Professor Galloway. Apple's always been good at being the second company. So essentially, you never want to be, and I've also learned this from Johnny Crypto working with him in Blockheads and our software company. You never want to be a for an early adopter of something. You want to let the other people innovate it, and then what you want to do is you want to come in and make it better. So if you look at the smartphones, Apple wasn't the first smartphone; it just did it better. Apple wasn't the first MP3 player; it just did it better with the iPod. Right? Again, you want to figure out all of the things that are ending up wrong in it, and then you want to be the second mover in a specific space. And that doesn't mean that that first movers can't gain traction, but again, if you sit tight and learn what's going on and have a plan to enter that space as it starts getting more developed, you can make things much better and then take a part of the market share, which is also the thing that I think is going to happen with Apple's glasses when they release them as well, which should, they might have, I don't know if they've released them at the developers conference yet or talked about it. But one of the things that they did talk about is the improvements to Siri, which they haven't really been making any improvements into Siri over the short term. It all points to, and all of this points to one undeniable reality for the markets. In the $1 trillion AI race, the companies that control the physical constraints of growth, the data centers, the power generation, and the chips are traditionally going to be the ones that hold all the power. But I do believe Apple's going to be, I think Apple. So Tim Cook might not have been wrong in not doing it. Um, I think that I think that they might have been late to the game, or there might be the fact that they have been planning to get into the game and they want to make sure that they do it right, because they do have an obligation to shareholders and they don't want to specifically waste money. One thing that I think Tim Cook did do since he became CEO, because this is the largest growth of their shares of stock since he was CEO, at least from my recollection, is that he was really focused on the operations and managing it as a CEO rather than an innovator. And the new CEO, and I can't remember his name right now, I think the new CEO is going to be able to be a good cross between innovation and operations. And I think that we're going to start seeing some really, really cool stuff from Apple. But as far as it relates to AI, I think Google's still going to be the AI powerhouse, and that's who I'm betting on. I think Sundar is one of the who's the CEO of Google. I think he is one of the most underrated CEOs that are out there, and I'm excited to see what he continues to do and what they continue to do at Google. So, since Apple's using the Google hardware infrastructure, it's using it by partially training its AI tools on Google's powerful property chips known as TPUs, or tensor processing units. Apple relies on Google's data centers to operate its top and generative AI model. It's called AFM Cloud Pro, and it runs on Google's cloud infrastructure using Nvidia chips. The AI models Apple uses are officially developed in collaboration with Google, and are distilled from Google's Gemini chatbot. In the practical application, what this means is that while simple AI tasks are processed locally on the user's iPhone, the most demanding and complex requests, such as parsing, say, a 40-page PDF contract, are routed to the more powerful AFM model running on machines inside Google's facilities rather than Apple's own computer network. So, because building core AI models obviously is extraordinarily difficult and expensive, this seems to be a wrapper that Apple's going to use in the meantime. But I would, like I said a moment ago, I would not count Apple out in eventually getting into this or continuing to build this partnership with Google. And again, it goes into one of the things that we've talked about on the New Wealth Transfer podcast, and I talk about on here, that all of this revenue is just going back and forth between all of these large tech companies, and this is truly a techocracy. There's a book, I haven't read it, I need to buy it and read it, and I'll try to do a review on my I'm revamping my Age of Jeremy overall website to get more blogs and book review articles in there. And I'd love to review this, but there is a book about how the new oligarchs and the new aristocrats are all going to be these giant tech companies, and I think that we're really coming into that. But if I had to play, I would still put Apple as a buy, and I would still put Google as a buy for the long term from a stock purchasing perspective, because I think that the Apple's going to continue to win with the goggles. They're going to continue to win with AI that are in devices, I think, because they do that so well. They do it better than any of the other companies. But I think Google's going to win in the overall AI race and also with their data centers. As I said, a lot of these AI companies are mixing together, and I'm going to talk about that as it relates to CoreWeave. Since its initial public offering in March 2025, the AI data center operator has seen its stock price more than double, pushing its market capitalization to a staggering $56 billion. But while public market investors are rushing to buy into the picks and shovels of the AI boom, again, you go and you buy the picks and the shovels, and that's where you make your money. CoreWeave insiders are taking some massive chips off of the table. The company's three billionaire co founders, Michael Intrator, Brianne McBee, and Brian Venturo, have unloaded more than 2.3 billion worth of their holdings. Chief Strategy Officer Brian Venturo alone has sold over 1.1 billion in shares since the company's lockup period expired in August, making him the second largest insider seller by value this year. And it's not just the founders. Magnetar Financial, one of CoreWeave's largest backers, has dumped more than 5.5 billion worth of stock since the lockup expired, cutting its position entirely in half, down to 9.7%. Now, the company points out that these founders' sales were prearranged under 10b5-1 trading plans to manage personal liquidity, and the trio still holds a combined 18% of the outstanding shares. However, Paul Meeks of Freedom Capital Markets called the massive insider sales obviously bad optics, even though he personally maintains a bullish 151 price target on the stock. The insider selling wave comes at a time when CoreWeave's underlying fundamentals are under intense scrutiny. First quarter revenue more than doubled, but the company is burning through capital to build out its infrastructure. Total debt is nearing 25 billion, roughly a quarter of their revenue is going toward interest payments, and the company is yet to post a profitable quarter. There are also lingering questions about their business model. Specifically, and I mentioned this before, everybody's paying everybody. It's a circular deal. They have a circular deal with Nvidia. Nvidia is a major investor in CoreWeave. It manufactures the highly coveted GPU CoreWeave leases out, and it has concurrently agreed to buy 6.3 billion worth of cloud services right back from the firm. And it's a high stakes balancing act of hyperscaling versus debt, and the founders have clearly decided to lock in some of their gains while the market is still hot. And I think that that's the key here, is that while they went through all the filings properly, everybody knew that they were going to be selling it. The point is that did they really sell it for a personal liquidity position? Maybe. A lot of the times investors put their heart and souls into these companies. I'm sorry, the founders put their hearts and souls into these companies, and when it goes public, that's an opportunity for them to get paid for some of their hard work and years of doing it. So that's not unlikely. It's also a time for initial investors to kind of get out of it if need be. The financial company, I think it was Magnetar Financial, they dumped more than 5 billion worth of stock since their lockup expired, and that's a way for them to take some of the profit off the table so that they can give it to their partners or whoever that they have to, maybe they have to pay bills on it too, who knows. But the point is that can happen, and that's why a company can go public, right? Is for that specifically. But again, in the situation that we're in right now, seeming that a lot of people are starting to turn bearish on what this is going to look like overall for AI in the short term or maybe the midterm, this could be an indicator that the market is rethinking how it looks at AI and what that growth potential is for AI. All of the AI stuff came so fast. It's very similar to a dot-com boom. We're living in the AI boom, and some of these companies are not going to succeed, and some of them are. However, when we think of data infrastructure and what's happening, you are going to need companies like this for the data infrastructure to be able to process all this. Think about what I mentioned earlier about Apple. When you run a query on iPhone now, it's going to do the query itself. But if it has to do like actual work, like review a 40-page PDF, it then has to go over to the Google's cloud where it's going to process the information and then wrap it back around or put it back around into Apple. Okay. That takes a lot of processing power, especially if millions and millions of people are doing that every day. So the way that I look at it is eventually, if this continues, we're going to have data centers in the sea. We're going to have data centers in the space. We're going to have data centers all around us if it continues to grow. But what I think is going to happen is eventually the marketplace will stagnate itself or get to a period where it is mature. A lot of the smaller companies will go away, and we won't have to rapidly build all of this infrastructure. And then the infrastructure can just become better. And hopefully the software will eventually become better. And then it can drive down the prices of these things. And if they really take into consideration the heating process, the heating problem that arises with GPUs, they'll start to do a different way to heat them rather than using water to actually, I'm sorry, not heat them, to cool them off rather than water to cool them off. But I think that as we mature, we'll start to do those things. And then hopefully we can improve this for the environment, for all of mankind, and we can still see the benefits of artificial intelligence. But again, I would be concerned about the circular deals that are made with all of these companies. It seems like all of the revenue of them are coming from other companies that are then getting their revenue from other companies. So when someone is getting money to then pay for what they need to do by getting money from one of the other people that have given them money, it kind of just sounds like a giant tech Ponzi scheme to me. It's a legal Ponzi scheme of just revenue being moved around between them and making them look like they're profitable and they're making revenue. In this case, CoreWeave's not profitable, but look like they're making revenue when in reality, they're actually not. But if you think about this, there's a 151 price target on CoreWeave right now from Freedom Capital Markets, Paul Meeks. So maybe it's time to actually buy some of this and get your hands on the picks and shovels. But again, I don't think that that's going to be for the long term. So these might be some short term speculation plays. Something to think about. All right, let's close this out today. Let's head on over to South Korean markets and what is going on with the Kospi, if I'm pronouncing that right. Should probably look at how to pronounce things sometimes before I do these. It looks like South Korea just experienced a truly historic and chaotic 24 hours of trading. The South Korean benchmark, the Kospi, just witnessed a massive 16% market swing after suffering a sheer 676.8.3% plunge on Monday that sent the index tumbling below 8,000. The market roared right back, though, with an 8.18% recovery on Tuesday. To put the sheer scale of this volatility into perspective, Monday's drop was the fifth most severe on record for the Kospi. So, what is driving the roller coaster action? The answer lies with South Korea's retail investors, known quickly in the local media as the ants. I'd love to be referred to as an ant because I love ants. These retail investors are driving the market using extreme amounts of borrowed money. According to a recent report from the Bank of Korea, leveraged equity investments by these retail investors surged to an all time high of $39 billion in May. A significant portion of this speculative frenzy is being funneled into geared exchange traded funds that offer exposure to two specific indexed heavyweights, Samsung Electronics and SK Hynix. Because these two memory chip makers alone constitute roughly half of the entire Kospi index, the South Korean market has been closely tracking the V-shaped trading patterns of the Philadelphia Semiconductor Index, also known as the SOX, which is located here in the United States. The trading environment has become so fanatic with daily turnover on the Seoul exchanges averaging around 106 trillion won or 70 billion in May, that regulators have had to step in. Market circuit breakers and algorithmic trading suspensions, known as sidecars, were triggered both during Monday's crash and Tuesday's massive rebound to try and curb the excessive volatility. In case you're not sure what a sidecar is, after the 1987 market crash, US future exchanges used mechanisms nicknamed sidecars that coordinated trading halts between stock and future markets. These were predecessors to today's market-wide circuit breakers. So sidebars and circuit breakers are essentially kind of like the same thing or do the same thing now. Despite the wild leverage swings, strategists are at major firms like Goldman Sachs and Nomura emphasize that the South Korean market still maintains genuine fundamental appeal. Now, the ongoing AI boom has significantly boosted the earnings prospects of some of the major technology stocks, allowing their valuations to largely keep pace with the booming share prices until, of course, that AI boom goes away and everything goes down. But however, there is one major macroeconomic headwind upsetting investors right now: the continual weakness of the Korean won. The currency has depreciated almost 6% against the US dollar this year, despite South Korea boasting record exports, lower inflation, and a huge current account surplus. This persistent currency weakness has sparked rumors across the market that the Bank of Korea might step in and hike interest rates this month to defend the won. The reason why I wanted to point this out was because of the fact that we are in a midst of a worldwide AI boom. And I want to be clear that eventually all bubbles will burst. And when that bursts, our economies are going to go down and eventually we're going to have a recession. And I do believe that this is going to be caused by artificial intelligence and the cyclical nature of how they're achieving revenue and profitability from each other without creating any real new revenue inside of the space. So it's really important that you're being mindful of how you're investing into AI infrastructure, into AI companies, because again, as this dot com or AI com era, similar to the dot com era, as it eventually bursts, everything's going to start to become consolidated. So be mindful of where you're putting your money. Make sure that you're taking profits, and make sure that you are staying diversified. And that wraps up another day of Markets Radar. Again, this is being recorded on June 9th, 2026. We will see you on Saturday. I guess we won't see you. You'll hear from us again on Saturday, June 13th, for another Markets Radar. And right now, this is coming at you on the Age of Jeremy feed. So make sure that you listen to my other episode of Age of Jeremy, which will be dropping tomorrow, June 10th, which are my business adventures and side quests. So for now, that's that. And as I always say, be faithful, grateful, and kind. We'll talk with you soon. Bye.